Welcome to the beautiful city of Seattle, the Emerald City, which made me think about another connection. I work and live in the Emerald Isle, and I've just, according to Shakespeare, so it's great being in the Emerald City. Thanks again to Clara. This was an incredibly warm speech. And I can confirm that I didn't dream to become an insurance supervisor when I was 10, in part because I did not know what it is. With that, I'm pleased to say that we have had already 3 days of productive meetings, very calm meetings, in line with the initials of the president of the NESC, advancing the work we will discuss over the next 2 days. When we met in Santiago in November at our annual conference, I reflected on the fact that many economies, and the global economy in general, were at an inflection point. The global economic outlook was challenging, with darkening clouds and in terms of projections for global GDP and growing inflationary pressures following the rapid changes to monetary policy as it was responding to inflation in the big economies and a number of other economies. The start to this year has not left us short of new developments. It is increasingly clear that we are living in a multi-crisis world where kind of shocks are hitting us, and very often shocks that we could not have possibly been able to predict. Consider the economic impact of supply chain issues following the pandemic, which were compounded by war in Ukraine. Very difficult to have predicted any of those when we were sitting in Abu Dhabi at the end of 2019, for instance. In turn, look at the pressures we are seeing in the financial system as the speed of resetting interest rates has a global impact. I mean, these pressures, to some extent, have crystallized in the banking events, in the regional banking events we have seen in the United States, again, they had a sort of relatively contained spillover to the rest of the world recently, but yet again, they did produce a trigger that led to the demise of a global systemically important bank in Switzerland. And there have been instances in several jurisdictions, depending on the particular market structure of insurance there, where the rising of interest rates has produced challenges. So, as insurance supervisors, we are also aware that insurance has a significant role to play in this world on the positive side as well, not only to protect against the balance sheets of insurance companies and therefore policyholders, existing policyholders, against the uncertainty and the shock, but it is an uncertain world, and insurance basically protects people from uncertainty, for bad things that can happen to people. And there is a real potential to provide resilience and protection. So this is the, if you want, the bright side of the dark side of the moon. I needed to cite Pink Floyd, given that I come from the UK and I'm in the city of grunge. So as supervisors, we have a role to play in supporting the effective functioning and governance of a global market. To this extent, we have started this year in a strong position despite the headwinds. Fresh from the endorsement by the FSB of the IAIS's holistic framework at the end of last year, We are now using the global monitoring exercise in anger to assess risks in the insurance sector and as a basis to coordinate supervisory responses at the global level. Furthermore, we have kicked off progress monitoring on identified gaps from the implementation assessment. We are also drawing heavily on our Macroprudential committee, whose working groups have been actively monitoring developments in financial markets, including the interconnectedness to the banking sector, which, as I said, has had some issues recently. From this, we have seen that insurers' exposures to banks vary significantly across jurisdictions, from very small to material. So, for example, on the material side, in some jurisdictions, it can reach close to 35% of aggregate assets. In other jurisdictions, sovereign exposures are more prevalent than financial sector exposures, and this will be relevant if we were to see further deterioration in sovereign debt conditions, which are, you know, sovereign debt as a percentage of GDP is very high in many jurisdictions, amplified by the response to COVID. Nevertheless, so far, with the exception of some idiosyncratic cases, which I mentioned, I referred to earlier, the insurance sector has remained resilient. Preliminary lessons learnt underscore the importance of basic principles of sound risk management. For instance, no excessive risk-taking through leverage in hedge funds or derivatives, and sound asset liability matching, taking into account liquidity and concentration risks. These volatile conditions continue to underscore the value of global coordination on insurance supervision and the importance of a common language for the supervision of internationally active insurance groups. We are now moving full speed ahead with the final steps to develop the insurance capital standard. Just to plug that we have a panel with distinguished speakers on ICS tomorrow. But for now, suffice it to say that following our meetings this week, we are firmly on track and in agreement on the need to deliver the final ICS by the end of the year, with the most immediate milestone being the start of the public consultation next week on the candidate ICS. We have also been able to significantly advance the work on our key strategic themes. As we will set out over the coming days, we have made good progress in the areas of climate risk, operational resilience, and diversity, equity, and inclusion. On climate risk, last month we finished the first of a series of consultations to ensure that these risks are effectively reflected in our supervisory material and thus effectively integrated in practical supervision. On operational resilience, I'm pleased that also last month we published the final version of our operational resilience issues paper. On diversity, equity and inclusion, we're making good progress exploring the sector's efforts and steps taken by supervisors in various jurisdictions to support D&I objectives, while also further embedding D&I in our own internal processes. Our Financial Inclusion Forum continues to be a powerful platform for sharing supervisory experiences to make insurance markets more inclusive. Working with the Access to Insurance, the forum is taking forward a review of our financial inclusion application paper, which will be published for consultation in early 2024. Importantly, we are also starting a consultative process to develop the IAIS's next 5-year strategic plan, which will start in 2025. We released a stakeholder survey this week, and tomorrow we will use the opportunity of the global seminar to seek input during 2 panel discussions. I began my remarks today speaking about the importance of the insurance sector in building economic resilience across the societies in which we live. This is particularly true for natural catastrophes. The insurance sector has the potential to protect communities and livelihoods in the face of natural disasters. From flooding in Germany or Bangladesh to wildfires in Australia, and California, or indeed in eastern Canada more recently, which of course spread had consequences for places like New York. The type of weather events which I understand are impacting the very region also we are now. However, our work on natural catastrophe protection gaps highlights a number of challenges to the sector to be able to successfully address these risks. Many of these hurdles need to be tackled by the public and private sectors together, and as insurance supervisors, we're also keen to understand the role we can play. Therefore, in time for our annual conference in November, we will publish a report that analyzes the various types of initiatives undertaken by insurance supervisors to distill the key elements of possible responses and consider future actions in this area. We'll discuss our process on the NatCat panel tomorrow. You can see we have an expansive and interesting agenda, and therefore I'm pleased we can come together this week to jointly take forward the IAIS's important work. I'm now going to join our colleagues on the panel as we dive into a little more detail on these issues. Over to you, Jonathan.
Okay, excellent. So you can see joined by an excellent panel here this morning. Good morning to everyone. Good morning to everyone in the audience. Fantastic to see so many people in person again, and wonderful to be here in Seattle. And my thanks also to Mike, to Clara for organizing such a wonderful event and hosting us so hospitably here in Seattle. So without further ado, let's get going with the Q&A session of the EXCO dialogue. And as you heard, we'll do it slightly differently this year. I will run through a series of questions to the panel, more or less along the lines, actually, of the high-level goals which drive our activities within the IAIS. Please remember also to send any Slido questions that you might have, and we'll try to weave those into the discussion as well. So let's get started, and we'll start with high-level goal 1, which is really the work that we do to assess vulnerabilities, risks, trends in the global insurance sector. And Dieter, as our chair of the Macroprudential committee, I'll start with you. And as Vicky referenced, it has been a turbulent time in global financial markets. Can you tell us a little bit about what the issues are that we're looking at in this year's global monitoring exercise?
Yes, thank you, Jonathan, of course. I think Vicky highlighted it very well, and I can only confirm what she said in terms of a challenging macroeconomic and financial environment. And it's key that we try within our global monitoring exercise to monitor the impact of that environment on the insurance sector. So let me start to advertise our own GMAR report. So that's the annual report we do publish, where we try to communicate our findings of our monitoring exercise to the outside world. And the last one was published end of last year, and already contained a lot of relevant discussions and analysis on the current macroeconomic environment and its impact on the insurance sector. Now, let's zoom in on today. So we've had great discussion earlier this week at the Macroprudential Committee, and basically what we tried to identify were two big themes, two big risk themes, which we would like to monitor through the course of this year. The first theme is rather broad, to be honest, and actually tries to identify those risk elements in the current macroeconomic environment that may have an important impact on the insurance sector. Allow me to list three of those. Increasing interest rates. Normally, increasing interest rates are a good thing for insurers. We know, for instance, that for life insurers that guarantee a certain interest rate, that increasing interest rates usually help to boost up the profitability. Now, what we do see is that when interest rates increase rapidly, that could bring some challenges. And what we've also seen is that for some currencies, the interest rate curve has inverted. So the short-term yields are higher than longer-term yields, which brings some challenges in terms of duration matching for certain insurances. Along with this increasing interest rates, we have seen and we know that this can be linked to collateral calls in case of the use of derivatives. So this brings also liquidity issues that we would like to monitor. And we have seen that surrenders in certain jurisdictions have increased. So the volume of surrenders, life insurance contracts which are lapsed have increased. And a very interesting observation we made following the recent turmoil in the banking sector is that within a digitalized world, it seems to be very easy for consumers to move around money. And this aspect is also something we would like to investigate for insurers, whether that could lead to more rapidly surrendering life insurance contracts, or whether that could lead to an increasing volume of surrenders. So interest rate and liquidity risk are very much linked. Secondly, credit risk. We do have some debt sustainability concerns with regard to certain corporates and governments, and we know that the insurance sector is exposed to government and corporate bonds, so that's something we need to monitor. And lastly, real estate. We know there are some concerns about real estate valuations, and we also know that in certain jurisdictions, real estate exposures are quite material for the insurance sector. So that's also something we need to keep monitoring. Allow me to go to the second theme, also a broad theme, which basically zooms into the life insurance sector, and we've seen some changes in terms of business model and strategy that are worthwhile following. Changes that are often interlinked, so it's a combination of a more extensive use of cross-border asset-intensive reinsurance on the one hand, and a move to alternative investments on the asset side on the other hand. So we really want to understand here what is happening and how these two elements can be linked. These two themes will basically determine our monitoring agenda for the rest of this year. I can also add a last element here that in terms of monitoring, we are also developing indicators that are very much linked to these risk themes. So you can imagine indicators in terms of credit risk, reinsurance, and derivatives that should help our monitoring efforts in this respect, and for which, once developed, we will also consult with all stakeholders involved to see what we do or to check what we do, if that's reasonable or not. So, Jonathan, I can stop here. I hope that is an overview of what we're doing here.
And maybe I can turn to Gerry and to Petra from US and Europe respectively, to see if you have any points to add in terms of what you're seeing in the current market.
Yeah, yes, let me start, and good morning everyone. Good to see you all. Thank you, Seattle. Thank you, NAIC, for having us here. My microphone's, now it's better. I was saying good morning everyone. I was also saying thank you, Seattle. Thank you, NAIC and IAIS for organizing a wonderful event. We've been here already for a couple of days, and besides good meetings, it's a great place to be. On what we see in the EU, I think it's so much aligned with what Dieter has been saying already, but maybe to add to what he said. From a European perspective, what I find as a supervisor currently very helpful when we are going from crisis to crisis, and you can't predict them all, but you have a modus, I think, to work on when you see developments in the market. Even if it's banks in America, you start working as a team, you start monitoring. What do we monitor? We monitor liquidity and robustness, solvency. It's extremely helpful to have a robust regulatory framework, because on the solvency side, each time there's no concerns. And that gives a certain ease in dealing with the situation. The system is robust. Solvency in Europe is around 250%. Liquidity, is it a risk or not for insurance? It's a discussion that's often there when we discuss it. Well, anytime there is a crisis somewhere in the markets, I do get the question, how is liquidity doing for insurance? So it is extremely helpful that I can then very quickly say, yes, we've got the data, we did the analysis, it's currently not a concern. So I think what I find more and more is that even though for sure liquidity can be a risk, but it's maybe not the most important risk in insurance, simply being able to have data and be able to monitor it so you can quickly answer questions and make sure, and I think Clara said it very well, we stay calm is very important. Final observation, I really see that conduct supervision, the need to think from a consumer-centric perspective, the focus also of supervisors to get value for money and make sure that products that are sold are actually helpful, that clients, potential clients, policyholders get products that help them really deal with the risks of daily life. I think that is getting more and more attention, and here value for money is important. It's a very big theme currently in the European supervisory community, as well as very clear and crisp, understandable information. And then going back to my role in the IAIS here, for sure, digitalization and new innovative tools can help. So there's also a lot of opportunities there, so to reach more people, to deal with more risks, but there's definitely also a need. And I'll stop there.
Yeah, good morning, everyone. Nice to see everybody. I must admit that it's more pleasurable to not have to experience the jet lag and just be a few hours from home. So it was nice, so I get to see it in your faces and not mine this time. But it's really been a pleasure. I got to say, too, thanks to the IAIS Secretariat for the program that has been put together, and to the NAIC staff who have worked through the logistics to make all this happen. I know I mentioned that last night, but this is a really large undertaking and done expertly. Happy to talk just a little bit about kind of on the U.S. side and a little of the recent kind of short history between March and May when we saw the failure of 3 regional banks in the U.S. And talking to one of our lead financial analysts, I think Dieter did a very good job of putting the technical components together. I think one of our lead analysts, when referring to the exposure of the insurance market, called it a nothing burger. So I think that's the technical parlance, if I'm not mistaken. But with what happened with the failure of those 3 banks, triggering, of course, financial assistance from the federal government in the form of credit lines, deposit backstops, and also causing concern about the overall health of the U.S. banking system. So to prevent a collapse, the Federal Reserve established a $25 billion emergency lending program, which included cash from Treasury, offering 1-year loans to eligible depository institutions in exchange for collateral. And largely due to that kind of assistance from the federal government, the banking system concerns have mostly subsided. The deposit outflows from the banks have decreased, and policymakers are considering changes based on reviews by the Federal Reserve and the FDIC. But at the same time, the potential for market stress does remain. Federal officials are currently trying to avoid a credit crunch while fighting high inflation, which typically can call for opposite solutions. And we've most recently saw 10 consecutive interest rate increases to combat that high inflation. That reached a 16-year high in May 2023. And maybe I'll just touch on some of the more specific data that we collect through the NAIC on the total U.S. insurers' direct exposure to the banking industry. It was about $788 billion. That represents about 8.75% of total cash and invested assets at the year end of 2022. And that's represented by about $633 billion in bonds, $89 billion in common stock, $10 billion in preferred stock, and about $55 billion in cash. And among the 3 mid-sized regional banks, preliminary data show that the U.S. insurers had a total of $1.5 billion in bonds, stocks, and cash with SVB, about $382 million with Signature Bank, and about $1 billion with First Republic at the year end of 2022. So, all that said, the NAIC Capital Markets Bureau continues to monitor the events and the developments, as well as the industry's exposure to the overall banking sector. But thus far, as I said at the outset, it's not identified any material adverse impact to U.S. insurers' banking sector investments.
Great. Thank you very much. And it would be remiss when we're talking about risks not to mention that we also look at two other particular thematic risks in our work as well, one being climate-related risks and the other being cyber risks. I'm conscious of the time, but I would like to ask first Daniel and then Dieter to talk about each in turn. We have a round table on cyber later today, so we can keep that one perhaps particularly brief. But first to you, Daniel, if you could talk a little bit about how we're looking at that within the GME.
Yes, thanks, Jonathan. Make sure can you hear me? Okay. So yeah, climate data elements have become a regular feature in the IAIS's GME, the Global Monitoring Exercise. So we have now been collecting data for 3 years running. While this remains an iterative process, the data collections do provide a global baseline of climate risk data for the insurance sector. This in turn paves the way for better analysis of climate change and the impact on the global insurance sector. So the 2023 GME data collection was launched in March. This is the first time we have included an optional data request to individual insurers. And I must say that the responses have been very encouraging. We have since received data from insurers on investment exposures, risks related to net cat, as well as responses to various qualitative questions on the risk assessment and individual insurers' responses. So the data of the individual insurers was due in the middle of May, and the data coverage has been good. We are currently analyzing the data, and I'm really looking forward to going deeper into it. And we'll report our analysis in the end of the year GMA report. We will also continue to provide recommendations to refine next year's GME data collection exercise. And because this work supports the IAIS's high-level goal to access global market trends relevant to the sector.
Yeah, how to be short about cyber. Well, let me start, since I'm in an advertising mood, let me start again to referring to our GMAR, and we have published a GMAR report which specifically focuses on all the work we've done around cyber. It's impossible to summarize this report in 1 minute, but let me try to highlight 3 elements. First of all, what we see is a market hardening. There is a large demand for cyber, a growing demand for cyber. There is an increasing cyber attack surface with increasing ransomware attacks, etc. And as a consequence, we see that the larger demand is confronted with a tightening of the market, with tighter conditions, as insurers, of course, are aware of the risk that they are taking and don't want to run any risks that would be exaggerated. So in this sense, cyber risk is still very much a market, or cyber underwriting is very much a market that is characterized by a protection gap. Second of all, we see a heavy reliance in the cyber underwriting market on reinsurance. So 40% of the premiums that are incoming are also reinsured, which means that the capacity in the cyber market, cyber underwriting markets, it's very much determined by the capacity that reinsurance offers to the direct insurers. And third of all, in terms of conclusions, it's fair to say that if you look at affirmative cyber, so far we don't think it has a huge impact or could have a huge impact on the financial stability of the insurers themselves, as the volumes of the cyber underwriting affirmative market are still quite contained. We do have to acknowledge that in terms of silent cyber, so non-affirmative cyber, there is some work still to be done, both on the side of the supervisors and on the side of the insurers, as data gaps remain, and we have not fully mapped yet the potential risks that could be underlying that. So,
great. And we have, I'm going to do one quick Slido question to reward those who have come in with questions. And the question, maybe I'll send it to you, Dieter. What risk do you think the insurance industry currently underappreciates? in the present environment?
That's a good question. Well, I think Petra referred to it. So liquidity risk, and I don't want to compare insurers with banks here, is definitely a risk which, if you talk to some insurers, they are very much aware of it. If you talk to other insurers, they're less intensively working on it. So I can only repeat what Petra was saying. I think it's key to monitor your liquidity risk profile. And this can lead to the conclusion that as an insurer, in certain circumstances, you are not very vulnerable in terms of liquidity risk, but you should measure it. And I think there is still some work to do. If you look also, for instance, at the framework we have in Europe, Solvency II, the number of times liquidity risk is mentioned so far is unfortunately very low. We are working on it in terms of the Solvency II review, but it's a good example of, I think, the way in which we need to beef up a little bit the liquidity risk elements into the Prudential framework.
Very good. So I think we should move on to our next high-level goal, which is really the work that we do around standard setting. And Alan, we'll start with yourself, Matt, and you took on the enviable task of PDC chair late last year. And it's got a busy agenda, the PDC, but of course development of the ICS is a big focus at the moment. We have a panel session on the ICS tomorrow, but maybe you want to give a little bit of a high-level overview of what's happening on the ICS project.
Yeah, thanks. It's nice to be up on stage this year. Hi, I'm Matt Walker. I'm the new chair of the Policy Development Committee. Although, Gerry, I appreciate all the shout-outs to the Federal Reserve in your remarks. I wish you would have told me a little more about what this job entailed. I do need to start with a bit of a little legal disclaimer. While I am with the Federal Reserve, I am speaking in my capacity as the chair of the Policy Development Committee today, and my remarks are not necessarily those of the governors of the Federal Reserve System. So back to the ICS. It was a key week for us this week. We approved a consultation document, which I understand will be launched next Friday. This is a key milestone for the ICS. Along with that, we'll be consulting on a couple other documents. We have related standards coming out on both valuation, that's ICP 14 for those of you in the know, and capital adequacy, that's ICP 17. These are closely related to the ICS, so we held them back as we were doing the other ICPs earlier, so we could let the work on the ICS develop further and let the CSFWG, our group that's tasked with a lot of this, make some progress. These are in some ways broader than the ICS. The ICS is really designed to apply to internationally active insurance groups. These ICPs are more foundational. They're meant to be applied by supervisors to all insurers as a baseline. We're also going to be collecting data on the candidate ICS this year. I see a lot of volunteers in the audience that submit data. I want to thank all of you. It's been an extensive process up to this point. I think we've had some statistics I saw put together recently, 9 years of data collections, if you go back and count some of the initial work on the BCR that led into the ICS. I've been told that there were 30,000 data cells in last year's data collection and a total of 4 million data points collected recently. I know that doesn't come free. I want to thank all the volunteers as well as everyone on this side that's worked on that. That data is really valuable to us. It's allowed us to make some revisions that I don't want to spoil the panel that's coming up, but we have been able to make some revisions in the candidate ICS because of that. But the work's not done for us. Next year, we're going to be busy processing that data. We have work to do on the economic impact assessment, and we have work to do on the aggregation method. I think the aggregate of all these things will put us in a good position by the end of next year to make some decisions on the ICS.
That's great. And just so you can plan your diaries, that will be next week, Friday, 23 June. We'll be releasing the ICS as a PCR consultation paper for a 90-day consultation period, so you can all plan your vacations accordingly. Very good. Now, we do have the panel, so we really don't want to steal too much thunder, but we do have the benefit of Gerry, Petra, and Vicky with us. We're running a bit behind time, so maybe I could ask for like a one-sentence sort of additional points for a bit of a sneak preview.
Just come to the panel, but basically we are on track. It's happening. Thanks for all the evidence that the volunteer groups have provided on the monitoring. During the monitoring period, we have 1 year more to come. We have based our revisions that you will see next week, and you'll hear some of it at the panel based on these data. So those of you who made the efforts will see how these efforts have actually been reflected in the standard that we're going to be consulting. So that's it.
Okay.
That sums it up.
Okay. Yeah. Petra? Oh, very good. So that's going to pique some interest and have a cliffhanger for tomorrow. Good. I mean, the other important area of work around our standard setting, and this reflects the sort of feedback loop that we have, is on our holistic framework, supervisory material, where, of course, we adopted the holistic framework in 2019. It was endorsed by the Financial Stability Board in December, and we undertook quite an intensive implementation assessment exercise in 10 major jurisdictions in 21 and 22. So the PDC has been looking to sort of develop or fine-tune either supervisory or supporting material for the holistic framework in response to the lessons we've learned from that implementation assessment. I look to both Dieter and Matt. Can you tell us a little bit about this work, starting with Matt?
Sure. I think you summed it up well, Jonathan, by calling it fine-tuning and mentioning the FSB's endorsement of this framework. I actually worked on the holistic framework back when it was being developed, so I'm somewhat sensitive on that. It's, I think overall it's been very positive, including with the impact of the implementation assessment last year, but we do have is some fine-tuning coming out of that. There are a few things we're going to be taking a look at it. Some of it's very technical and not worth getting into here, but maybe a couple things I would flag for the audience, especially on the resolution side where we saw maybe implementation a little lower than in other areas. We had some discussions this week on a couple aspects of that. One aspect is on resolution planning. There was the holistic framework requires resolution plans where those are deemed necessary by the group-wide supervisor. We maybe saw a little less consistency than we would like in that. We're taking a look back at that language to see if we can give some more clarity about what exactly is necessary. We're also looking at the list of powers that supervisors are expected to have to resolve the failure of an internationally active insurance group. Depending on how you count them, there's something like 22 or 19 powers that are prescribed within ComFrame to resolve an IAIG. We're taking a look at it, how to simplify that. But one thing that was clear from the discussions, both on the as necessary language for resolution plan and the powers that are required to resolve an IAIG, is that there's not a desire among supervisors to lower the bar on any of this. This is a fine-tuning, clarification of the holistic framework. It's not a relaxation.
Yeah, and if you look at the material related to the macroprudential supervision function, I think there's two elements worthwhile mentioning. First of all, data collections in terms of macroprudential supervision. We see that some jurisdictions are more evolved than others. We see also differences in terms of which data is collected, the frequency of the data collection. So we're thinking about developing a practical guidance for supervisors to make sure that the macroprudential supervision function and the data collection related to that will be a bit more streamlined in the future. And secondly, there is also a requirement to disclose liquidity risk information, and that disclosure should allow for a meaningful assessment. However, we have not clarified strictly enough what is meant by this meaningful assessment, which means there are a lot of different interpretations around the world. So that's something worthwhile thinking about, how to get to a meaningful assessment of liquidity risk.
Great, thank you. So still busy in the standard setting side, but moving now to high-level goal 3, which is really about supporting our member supervisors around the job of supervision. And we do various activities in that space. One of which is around increasingly providing platforms for sharing of supervisory experiences. And this falls under our Implementation and Assessment Committee, chaired by Peter Braumüller. So Peter, maybe you could tell us sort of quite briefly really about what's happening in some of these forums.
Yeah, thank you. Thank you, Jonathan. I think there is, undoubtedly, there is increasing need for more sharing good supervisory practices among supervisors, and also to facilitate the understanding of all those supervisory issues that are around the problems we have. And so we use the forums, and they have so far been really a success story because they are easily accessible, meet virtually most of the time, so they are open to also our smaller jurisdictions, EMD jurisdictions, and so on. Just let me pick up on, for example, on 3 of them. For a long time, we already have the Retirement Income and Pension Forum, and that continues to provide a platform for the exchange of views on supervision for retirement income and pension products, which is important because of the proximity between the pension area and the life insurance area. We also, I want to mention the significant input by stakeholders. We have here a discussion recently with stakeholders on recent developments in the liability-driven investment strategies or future of the life insurance business model. As a second example, I would quote the Financial Crime Forum, which plays a key role in keeping members abreast of developments related to financial crime across different jurisdictions, including supervisory implications, interplay with other regulators, and application of a risk-based approach. The forum is also considered to the possible fraud implications of greenwashing in the context of this application paper on climate-related issues being developed by the CRSG. And thirdly, the Supervisory Forum, a more long-standing forum we have, that comprises senior supervisors and provides a flexible platform for exchanges, practical experiences, and discuss existing and emerging trends and risks. So just an overview of a few of them. Thank you.
I mean, we also know, and as was referenced by Director Lindy Myers, issues of technology, FinTech, are top of mind at the moment, and increasingly so. And we have a FinTech forum within the IAIS, and chaired by yourself, Petra. Could you say a little bit about that?
Yes, I can. It's a great group. Is it working? Yeah. It's a great group, actually, of I think relatively young, energetic supervisors with a keen interest in what is happening, but also I might say many of them having a lot of knowledge, some really deep knowledge on particular developments, and we share that in the forum. And we've been growing. We have really seen, I think, only in the last 3 months, 10 new members joining, and it's a very nice, I think, place to share information. This forum. Now, what are we working on? AI and machine learning. Decentralized finance, blockchain, as well as open data, open insurance. Those are the key topics, although we do also use our time to monitor developments in the crypto world, as well as FinTech used to deal with, or FinTech, SubTech, dealing with ESG risk. In the interest of time, I'll focus on our top topic, which is AI. Which is gaining more and more, of course, attention from supervisors. It should. Naturally, it can bring a lot of benefits. It can help processing faster, bringing more products that are really fit to the needs of consumers, but it also entails risks, inclusion, bias, etc. So this is where we definitely see regulators acting, supervisors acting, and this year we are doing a thematic review of what exactly is happening in the many jurisdictions that are member of the IAIS on regulating actually AI. And with that, we will report at the end of the year. I would say this could actually be a topic that we then possibly could hand over to a standard setting committee, seeing if also the IAIS as a standard setter would need to act on this. So this would be our first candidate, maybe at some point to hand over, while for sure we keep continuing all the developments.
Great. Thanks very much. And I know we have many members from and some stakeholders from emerging market and developing economies with us today as well. And I think there are two forums which are particularly relevant there that Siham, you could tell us about. One, of course, is our Financial Inclusion Forum, and the other one is our Risk-Based Solvency Implementation Forum.
Thank you, Jonathan, for your question. I'm very happy to be with you today here to be sharing the stage with my IAS colleague, and thank you to the NAC for hosting us in this beautiful city of Seattle. Concerning the Financial Inclusion Forum, unfortunately, level of financial inclusion remains persistently high in many MDEs. Therefore, the FIF has an important role to play in helping supervisors to address these issues. This forum addresses a range of development and emerging trends through the inclusive insurance lens, such as protection gaps, digitalization, conduct of business, among others. The FIF is advancing the updates of the application paper on regulation and supervision supporting inclusive insurance market to reflect changes in the regulatory landscape since the initial publication of the paper in 2012, but also to add practical examples on the development and implementation of inclusive insurance framework. The fifth, bless you, the fifth, in close cooperation with the Access to Insurance Initiative, continues to advocate for the need and relevance of inclusive insurance within the IAS as well as the policymaker level. Concerning the risk-based solvency implementation forum, the forum was set up to support our members in advancing their observance of the IAS supervisory and strengthening their solvency framework. There was a strong demand amongst our members for the creation of this forum. The forum continues to hold a quarterly meeting to exchange experiences and discuss topics such as driver for the transition, key element of the risk-based solvency regime and implementation challenges. The forum is preparing guidance to jurisdictions on the practical aspects of implementing risk-based solvency regime, including different jurisdiction experiences and action to overcome obstacles to the transition. This work is carried out in close collaboration with the IMF, which makes a valuable contribution.
Great. I mean, we also have work on supervisory practices in other areas, so operational risk is one of them, and climate risk, of course, is another. But we do have some opportunities over the course of today and tomorrow to talk a bit more about that. But so I'll maybe move on from that to an area which is, I think, close to the heart of many of us, which is our work on diversity, equity, and inclusion. We unfortunately, we weren't able to have our outgoing EXCO DE&I champion, Helen Rowell, from Australia with us. And Helen did some truly fantastic work, and we were able to thank her yesterday. But I'm very happy that we're able to have our incoming EXCO DEI champion, Gerry Cross, from the Central Bank of Ireland with us. And Gerry's jumped straight into the job. So Gerry, could you tell us a little bit about the work being undertaken on DE&I and how we'll be looking to take it forward?
Yes, thanks, Jonathan, and good morning, everyone. And I know Helen is very sorry that she can't be with us this morning. But I do want to start really by thanking Helen, as Jonathan has, and acknowledging the significant impact that she's made. I think it's an example of someone really leading the way, and together with Lauren in the Secretariat, I think the last 2 years have really made a real difference in the work they've undertaken. And so I suppose my goal is in taking up this role, which I'm really motivated and honoured to be asked to do, is to maintain that momentum and progress that has been achieved over the last little while. I think the work of the IAIS on DEI is broadly twofold. One is working with all of the membership to work out how do we best enhance diversity, equity and inclusion within firms so that their governance, their risk management, their performance is enhanced and bolstered. And as a result of that, the outcomes for customers are improved and strengthened. And then looking at ourselves within the organization, how do we best achieve enhanced inclusion, enhanced engagement and leverage of the great diversity. That is one of the real strengths of the IAIS. So those are the two, I think, broad areas which are being developed. You'll recall that a stock take was carried out in the course of 2022 and the report on that stock take published at the end of last year. It's worth a look at. It's on the website, and there's a very good, very helpful executive summary with kind of 5 key findings that I think are really helpful in grounding ourselves in this work. And it kind of showed the real interest in this that there is, and the potential by some of our supervisory engagement and thinking to embed the benefits of that. So that is now sort of is finding fruition in the work both of the governance working group and the market conduct working group, who are very engaged around 2 aspects of this topic. One is looking at how we can enhance the performance and the outcomes that firms achieve themselves within their own governance and risk management and how they run themselves. And then the other is looking outward from the firms, how the embedding of diversity, equity and inclusion can really enhance the outcomes for customers, vulnerable customers, and the wide range of customers, and indeed including addressing protection gaps that may be there. So really interesting areas of work. If you want to know more about it, we will be discussing it in some detail in the roundtable this afternoon. Thanks, Jonathan.
Thanks, Gerry. I'm going to turn now to our high-level goal 4, which is around implementation assessment. So an important part of our cycle of activities, we develop the standards, we provide guidance on their implementation, and then we assess implementation, and that falls under our IAC as well. So Peter, maybe a little bit about an update on that.
Thanks, Jonathan. Can only be a best of in a few minutes on what we're doing. Just to group it, starting with the member assessment program, successfully finished the report on the member assessment for Albania this month. And this is kind of a very important element of our overall strategy on implementation assessment. A second very important role item is or instrument we have is the peer review process. Recently, in March this year, we published the aggregate report on the peer review on ICPs 9, which is supervisory review and reporting, and 10, which is preventive measures, corrective measures, and sanctions. And I think from both the member assessment programs and the PRPs, not only those involved benefit, but also the others, because we try to make them as instruments as useful for others to learn from the findings. Then, of course, the holistic framework was already mentioned, and we continued the implementation assessment work. You know, in 2020, there was the baseline assessment. Now, the TGA over 2021 and 2022 was conducted, and in April this year, we reached an important milestone in publishing the report on the assessment through the targeted jurisdictional assessment process. Finally, also about just saying that implementation work is broader than just the assessment work. Just to mention the capacity building efforts, I think we have done a lot on that. We have the number of regional seminars grew substantially over the year, and we have intensified the activities through our key implementation partner on financial inclusion, the access to insurance initiatives, so to support the members. And finally, also, we should not forget about the importance of cooperation, so working to increase the attractiveness of the multilateral Memorandum of Understanding, the MMOU. We have 5 more supervisors joined recently, and now we have 81 signatories representing more than 3/4 of global premium. Let me stop here.
Excellent, excellent progress. Thanks. I do want us to get to the open mic questions part of the session, but before we do that, I think it is important that we spend a little bit of time talking about our strategic plan and our stakeholder engagement. And these are very important aspects of our work this year. And as Vicky mentioned, and I'll turn to you, Siham, to talk a little bit about this, we are starting the process of developing our next 5-year strategic plan. So it really is a once in every 5-year opportunity to take a step back and think about these very deep questions around what's happening in insurance and the role of supervisors. What can you tell us about how we're developing this plan and getting input?
Yeah, happy to answer. And as you said, Jonathan, we are in the midst of developing our next strategic plan, which will set the strategic direction for the IAIS for the next 5 years. As a member-driven organization, we have been engaging with our membership to elicit views on the key elements of the strategic plan. And we also want to hear from our external stakeholder. Earlier this week, we released a stakeholder survey, which we would encourage all of you to respond to. We are also holding some panels session tomorrow, which will add to the discourse of the strategic plan. Overall, from what we have heard to date, we don't anticipate our high-level goals will change fundamentally. The nuance may change a bit, but in essence, they still remain relevant. There is also a recognition that the existing strategic team of the association as set out in the current strategic plan will remain relevant. In particular, climate risk was universally recognized as a key risk that is not going away. But we also need to consider how we can balance a focus on this enduring theme while also ensuring we do not overlook emerging risk and trends. And we also need to consider how we can focus our attention on work that really makes an impact. In other words, where there is a distinct insurance sector perspective. As we are building the strategic plan, we are taking a close look at first, emerging risk and trends that affect the sector of insurance supervision, the strategies and focus area that will best help us to achieve our goals, and how we can best serve our members and constructively work with our stakeholders. We aim to provide a preview into the key elements of the strategic plan during the annual conference in Tokyo. Then the plan will be endorsed and published in the second half of 2024.
Excellent. So interesting times ahead. One question for you, Vicky. So in Santiago, you mentioned that we're seeking to do more to engage with consumer groups. Can you tell us a little bit about what's been achieved to date?
Yes, 2 things. First, there has been a discussion recently amongst the market conduct group and consumer group representatives. That particular discussion was based on an earlier preparatory meeting to try to identify the issues. It was about vulnerabilities, consumer vulnerabilities, the role of disclosures, and the interest that consumer groups had on our work on natural catastrophe gaps. So they wanted to look at this particular issue. So they had a first discussion with the market conduct group. Second, you will see that in the panels that we have, the consumer groups are being represented much more than we have done in previous occasions. including on the first panel on artificial intelligence and machine learning and what it means for conduct regulation and consumption and consumer rights and consumer protection. The other angle that I wanted to mention is to highlight what Petra and Siham have said, that it's quite clear that we need to focus more of our efforts, given the emerging trends, but also given the focus we have had for several years now on prudential standard setting, on the implications of what we are seeing and the risks we're seeing for conduct. And that is likely to be, I mean, we haven't concluded our discussions yet, but to be an important strategic theme going forward. And within that, there is the role that the IAIS has as the membership, the prime global membership organization for supervisors, to actually help define what role supervisors have in order to provide resilience and protection to consumers in a world which, as I've discussed, is becoming more uncertain. So these are the initial steps. We have more plans to continue and sustain the engagement with further calls, and we look forward also for consumer panel representatives in the annual meetings in Japan. Thanks.
That's great. And I mean, I think that sort of reiterates the point that stakeholder engagement is a critical part of everything we do. And I wanted to mention, and to put out a sort of big flag on that here, that there's an important opportunity coming up next week. We will release a draft revised stakeholder engagement and consultation policy. And that will be released on Wednesday, 21 June, next week. And this policy sort of consolidates our stakeholder engagement and consultation activities with a focus on ensuring our engagement also recognizes our diversity as an association as inclusive and allows for equal access. So we last developed our policy, I think it was probably around 2014 or so. So this is as part of our good governance, re-looking that and seeing how we can benefit from the changed world that has happened in 7 years, including technology, virtual means, and so on. So for all the stakeholder representatives with us today, please look out for that coming out on Wednesday, and we would very much like to hear your thoughts on that. I'm going to move to the open mic part. We did get a few Slido questions, which we didn't manage to get to, but the good news is your efforts don't go to waste, because the questions that we got that we were not able to get to, we will deal with in our newsletter. So we will provide written responses to those questions in one of our upcoming newsletters. Good. Well, let's get going with the mic session. And I know, first up, we have a question from the Geneva Association from Dennis Nordhoek. And over to you, Dennis.
Thank you, Jonathan, for allowing me to ask the first question this morning. And thank you, EXCO, for your insights. I would like to stay with the AI topic for a while. So I think this is a question for you, Petra. It's no secret that since ChatGPT's launch just about a year ago, or November 2022, ignited widespread discussions around AI's potential threats and opportunities, stirring up anxiety about its impact on humanity. And this has put regulators, not just insurance regulators and supervisors, but wider policymaking communities under immense pressure to govern AI and to put up regulations and policies in place to protect consumers and citizens. And this has resulted in divergent strategies ranging from cross-sectoral approaches, such as done in Europe, to more principles-based approaches in other parts of the world. And it's no secret in the insurance industry, many firms are, of course, at a very different level in terms of adoption of AI. One of the questions I had in mind was already addressed by you, and that is really your mentioning of a possible handover to the standard setting committee after next year. So really, it was a question of what is the IAIS going to do? But my other question is around, I mean, there's so much that is being done, of course, within the insurance regulatory sphere, but there's a lot being done outside insurance regulation and supervision that also has an impact on insurers in the end. So the question is really, to what extent is there a role for the IAIS or insurance supervisors and regulators to build those bridges to policymakers not directly involved in insurance, but creating and crafting policies that in the end will affect our industry as well?
Thank you. Thank you, Dennis. I think you touched on, a very good topic. In Europe, we call it horizontal regulation, but what you see more and more is that, I think for good reasons, policymakers, regulators look for laws, rules, tools for supervisors in a cross-sectoral manner, sometimes not even within only the financial industry. And I think a good example is the Artificial Intelligence Act that was adopted by European Parliament. I'm a bit in a different time zone, I would say yesterday, but it could be 2 days ago. And what you see here is that this is then a piece of legislation which is very important. I think it's very good we start to regulate AI, but at the same time, and I think that is what you refer to, it is developed in a different part of policy making where the focus is on the technology. So what is the role here of a supervisor? Well, I think what is essential is that much of what is then drafted is done with good intention. It's about protecting consumers, avoiding bias, while at the same time not hindering innovation. I think that is always there. What is not always there is understanding insurance, understanding what it does. Comments like, Petra, did you know that insurance do a lot with data? They happen. And I think it just shows that people are not really familiar with the fact that insurers actually do data already for decades. And on top of that, they are actually quite already heavily regulated. So I think here what we need to do, I think as a community, so industry, but also supervisors, is monitor where these developments are, and start the dialogue, listen carefully to what risks need to be addressed, and then share the message to what extent that is already addressed or not. Because I think that's the other part you alluded to. These developments also go very fast, and they are often very new. Regulation, I think, by principle, always a little bit behind the curve. So principle-based here helps, but I think it also helps that from other more tech parts of our society, people step in and help us consider how to deal with risk, but also identify the risks. So this is where we can help identify where it is happening, explain the model of insurance, be open about the risks that are there, and then look whether or not new legislation is needed or whether it is in fact already regulated, and share that too. So I think this is what we can do individually in our jurisdictions, while indeed in the forum, but later on in standard setting bodies of IAIS, also bring together the standards that we then need, and again share that with those who are drafting.
Great, thanks. Our next question is from the Global Federation of Insurance Associations, and we have Tim Grafton with us. Thank you, Tim.
Thank you for this opportunity to pose this question on behalf of the GFIA. Our President, Susan Neely, is unable to be here at this very time, but she is in Seattle, so I'll be asking the question on her behalf. Earlier this year in March, the Global Federation of Insurance Associations published a report. That report was addressing global protection gaps and made recommendations on how to close those gaps. We focused on 4 main areas of protection gaps. We chose those areas because of their global relevance, because of their size, because of their impacts on lives and livelihoods, and also their likely evolution. And in that respect, we identified pensions, natural catastrophe, health, and cyber gaps. And together, we estimated that the cost of those gaps was $2.8 trillion, and that does not include the impacts on human lives and livelihoods. So we welcome the approach by the IAIS to address protection gaps, and you've established a task force to that end. So my question is, to what extent and how may external stakeholders provide input to that work? Thank you.
Great. Thanks very much. So our Protection Gaps Task Force is chaired by Shigeru Arazumi, who's EXCO Vice Chair, which I think is also a signal of the importance that the IAS collectively places on this topic, and strong support from the EXCO. Shigeru couldn't be with us today, but Daniel, who as you know, is our climate champion, will talk a bit about this. Thanks, Daniel.
Yeah, thanks, Tim, and thanks, Jonathan. So we'll totally welcome the input. I think that's the short answer. But really want to thank the GFIA for the report. Those of us involved in climate risk work as well as protection gaps work have read it with much interest. So my colleagues on the Protection Gaps Task Force also welcome the discussion they had with colleagues from the GFIA recently. And I believe there will be another discussion in the coming months. So this is a good time where we can exchange inputs into each other's work. As you know, we are also engaging very closely with partners such as the OECD and the Insurance Development Forum on these same issues. In fact, we'll get to hear from the chair of the IDF on the NetCat panel tomorrow. So these dialogues are really a key way in which we can engage on this project. And I'm sure Shigeru and his Protection Gap Task Force team will certainly reach out to yourselves and other industry players and partners for any information that you may need. So the work on the Protection Gap Task Force for this year focuses on natural catastrophe protection gaps. Of course, there are other types of just as important protection gaps that warrant attention. So when the IAIS publishes the report, as mentioned by Vicky, by the end of this year, this will also include discussion on further work on other types of gaps and also next steps. So if stakeholders like yourselves think that there's more that we should be doing on protection gaps, certainly encourage you to provide feedback, particularly through the strategic plan survey, which Jonathan mentioned earlier. So next week when it goes up, be sure to give your inputs. So we'll be really keen to hear that feedback. And of course, this is something that will come up in discussions probably over the course of the next 2 days, but in the coming months as well.
Thank you, Daniel. Next up, we have a question from the Institute of International Finance from Mary Frances Monroe. Mary Frances. There we go. Fantastic.
Melanie will be offering the question. Melanie, I've learned
Okay,
colleague from
great.
IAIS, yeah.
Thanks. Welcome, Melanie.
Thank you. Long-time listener, first-time caller. Yeah. As Vicky mentioned in her earlier comments, the IAIS recently issued its final issues paper on operational resilience in the insurance sector. In it, the IAIS discusses the need for a coordinated approach between industry and supervisors from multiple countries to address concentration risks stemming from third-party service providers. Third-party risk management has been part of the FSB's work program, as I'm sure you all know, with a public consultation on this topic expected next month. And my question is, what work is underway to address critical third-party and concentration risks, and how is the IAIS collaborating with the FSB on this cross-sectoral issue? Thank you.
Great. Over to you, Matt.
Yeah, it's a good question. One of the primary ways we collaborate is the IAIS actually sits on some of these FSB groups, including the one that's expected to issue proposals soon. in this area. This work follows a 2020 November discussion paper on outsourcing and third-party risk management, where some of the comments came back and mentioned this concentration risk issue. There were comments on the possibility of systemic risk from the failure of one of these companies, and there were comments that companies struggle to manage this because they often don't have the data on the concentration risk. They don't know which companies their competitors are using. The IAIS, as you mentioned, has done some work on operational risk. We did have the issue paper we released last month, but I think for both us and other supervisors and companies, it's less advanced on the concentration risk issue specifically than on operational resilience more broadly. We've had some discussions. We were lucky enough to be in Seattle this week, where a number of tech companies are located. We had both Amazon and Microsoft join us for part of the executive committee, and we had a good dialogue, but it's, yeah, we're still going to make progress on this.
Great. And last but not least, the International Actuarial Association with Nick Dexter. I laughed when you said long time no see. It does feel like June is very much stakeholder engagement and conference season. So we've seen each other a lot in June. But over to you, Nick.
Yes, for those who didn't know, Jonathan very kindly made a virtual appearance at our recent IAA meeting in Sydney, where myself and Roseanne Harris had the opportunity of chatting with Jonathan, which is very much welcome. Question we wanted to ask was about sustainability, really. So this is probably one for Daniel. We've heard quite a lot and seen quite a lot about the work the IAIS is doing on climate risk, but I think we're all considering the work that's ongoing with the ISSB. The IAA is considering its strategy in that area, and we've already started work on an ISAP to support actuaries working on sustainability disclosures. So the question was, what work is it that you're considering on wider sustainability issues over and above climate risk?
Okay, very good. I think there may be a bit of a combination here. Daniel, do you want to kick off? I think there was also a bit of a question around disclosure issues as well.
Sure.
Maybe touch on that recent development, and then I'll turn to Gerry, because part of what we're doing is also working on standards and supervisory practices in this area, which is a sort of PDC space. But
yeah, so I'll kick off first. Thanks, Nick, for that question. So very much a timely question, because I think many of us are in the climate risk workspace looking forward in the coming weeks on the finalized standards from the ISSB. So coincidentally, the Climate Risk Steering Group, which I lead, a couple of weeks ago, and it was also confirmed at this past weeks of meetings here in Seattle, that we will be forming a new work stream under the CRSG, looking at, among other things, the climate risk disclosures and reporting. So we definitely, at the global insurance sector level, need to track and monitor disclosure standards, requirements, guidance that will be forthcoming, not just from the ISSB, of course that will be probably the most important, but also in key jurisdictions and how they will be adopting or aligning where possible with the ISSB standards. But at the same time, the spectrum of sustainability disclosures is very wide. And what is most material and more directly pertinent for now, from a prudential lens, is the climate risk disclosures, and is also better aligned with the mandate of the this steering group that I lead. So we'll be looking quite closely at the ISSB standards, but from the perspective of climate risk disclosures, we'll also be looking at what the banking regulators and central banks, through the BCBS and even the NGFS, may be issuing guidance or expectations, because I think cross-sectoral alignment on disclosures will be a very vital project in the coming weeks and months. End of the day, this is a very positive development because with the disclosures and common alignment that will be coming out hopefully in the next few years and hopefully well implemented nationally in various jurisdictions, this will help play a huge role in the data shortage we see in the climate risk management space. So as financial institutions, as listed companies, and as other parts of the economic players all chip in over time to make disclosures, it will allow our financial institutions, including insurers, to make better climate risk management decisions.
Great. And Gerry, is there anything you would like to add with your EXCO Vice Chair hat on?
Yeah, sure. Maybe I'll focus just a little more broadly. And thank you for the question, Nick. And poor Jonathan, who was dragged to Sydney, Australia for an event. I feel for you. So yeah, more broadly, I think 3 areas are relevant, each of them championed by one of my friends on the stage, from Siham to Daniel to Gerry. The first on that is, as Siham was discussing earlier, is financial inclusion. The second is diversity, equity, and inclusion that Gerry has highlighted, that I'll underscore just a little bit. And then thirdly, more broadly on climate that Daniel has just discussed. And the first of that on financial inclusion, it's a strategic theme for the IAIS. Siham mentioned the IAIS's Financial Inclusion Forum is, because of efforts like hers, have gone from strong to even stronger. It's already helped to facilitate the exchange on digitalization, climate change, protection gaps, disaster preparedness. And I think Siham mentioned this as well, that this year we're review our application paper on inclusive insurance, and that will reflect changes since the previous version was published. The updated application paper will also consider different approaches to financial inclusion, given the increased innovation and digitalization and other trends and developments that have changed in the insurance sector since the original publication date about a decade ago. So I'd also flag our work here on natural catastrophe protection gaps, which has obviously been covered extensively already. And then, recently we've expanded our work on diversity, equity, and inclusion. Our work here is focused in 3 areas that I'll just quickly highlight. That's the interconnection between DE&I and the insurance sector, and supervisory mandates, and providing advice and examples for supervisors on a range of available supervisory practices to promote DE&I and insurance for better prudential and consumer outcomes. Another is considering the relevance and connection of DEI and other priority IAIS work, including on FinTech, climate risk, and protection gaps. And then that third area is exploring opportunities to cooperate with other international organizations and partners, such as our implementation partner, that is the Access to Insurance Initiative, so as to encourage supervisory dialogue, sharing of good practices. And then our climate work initially focused on understanding the risks of climate to insurers, and that is, what in sustainability jargon is often called outside-in risks. And this for insurance supervisors, as we know, is the bread and butter of what we do. However, as part of our recent work in this area and our climate consultation, we've asked stakeholders whether we should consider issues related to transition planning by insurers as part of additional further work. This could be relevant both for a traditional perspective, that is the outside in, but also from a broader sustainability perspective. So it's now for our members to consider whether we move in that direction. And I should also note, lastly, the work. We very much appreciate the collaboration with our partner, the Sustainable Insurance Forum, who actually met here in Seattle this past Sunday. That's it.
Yeah.
Great. I think we have maybe time for 1 or 2 open floor questions, if we have any. I see we have a perennial participant. Thanks, Yoshi.
Yes, thank you. Just one observation and to relate to comments. So compared with last year, first of all, excellent development, all the reports that we have heard. One issue I noticed the difference between last year and this year is, Vicky, you mentioned a role of supervisor is protecting consumers, not only existing policyholders. And of course, Chokla and our sort of discussion and Gerry that you mentioned is very much in line with role of supervisors, is shifting or focusing more on not only existing policyholder but consumers in general because of the climate change, because of this huge gap of protection, and also this issue might be related to Siham's financial inclusion, and of course climate and Petra's digital issue, but all cross-cutting issue is if we focus too much on existing policyholders, existing companies, our domain of activities less and less in proportion. So just my question or idea is IAIS, assuming that our focus is not only existing policyholders but the consumers in general, particularly underserved policyholders or not served policyholders, how do you see IAIS in the future, cross-cuttingly, not only standard setting, implementation, macroprudential approach, just a general question, observation. Thanks.
I think in terms of the need for supervisors to define the role on how to address protection gaps is immediately getting you into the arena of consumers who are not already policyholders, because if they were, they obviously would not be a protection gap issue. Now there is increased interest because of the emerging trends that we have discussed. I mean, the work that we did on cyber risks and the GMA has already, as Dieter was saying, has already set out that there is a gap there. There is a lot of demand and less capacity. The industry, the Geneva Association, has written about it, as we heard. This is one issue. The other issue was, and we've already sort of published a paper about it, about the pandemic protection gaps, which is one aspect of the health protection gaps. And now we're doing this work on natural catastrophe gaps. So that immediately brings you into this arena. However, our focus obviously needs to be on how we support supervisors to deal with these issues, because we are a supervisory community, and that should be our focus. And our supervisors, as well, as I mentioned, have different mandates. They all will have a mandate to protect policyholders. But the degree to which they have a mandate to develop their insurance market might differ from supervisor to supervisor. And given that we are a broad and very diverse member organization, we need to respect these differences and focus on how to support all of our supervisors in this particular arena. So yes, the issues and the risks and the issues that we have already seen do suggest that protection gaps in general are an area that we need to do more work on, but always from the perspective of what it means for us supervisors. Thanks.
Yeah, and I think that's right. I mean, I think, Yoshi, as you said, what we've seen in recent years is a real recognition of the importance of the insurance sector to societal goals, and therefore also recognition that all of us, including supervisors, have a role in thinking about what we can do, what the part we can play in addressing these very severe societal challenges that we face. So a lot, as you know from our EXCO discussions, what we shared, I think a lot of consensus and support to be doing that, while of course doing it in a way that doesn't undermine core supervisory objectives around financial soundness and financial stability, because of course they are critical to having sound and inclusive markets, is having stable and sound markets. I think we are, Gerry, did you want to add? I think we are, I'm getting signals that we're supposed to be at coffee. Thank you for joining us for the dialogue. I'm glad we got to cover what you will have seen as a very broad range of work that we're busy with. Thank you for the questions that we'll deal with in the newsletter, and I hope if you didn't have a chance to ask your question, you'll have a chance during the sessions that follow today and tomorrow. And thank you to the panel.